This week, there were a couple of questions that came in on the longer term outlook, especially as wave counts are changing. Some people were confused on the changes, and since I changed the medium term to up, so I think it required some explanation, and that's what I'm going to do. We are also at a very interesting point on the market in the very short term. So, before I get to the immediate intraday and short term traders, I think I need to do some explaining on the long end. I've been marking and talking about in the Condotype and long-term updates that the entire post 2008 market is a series of complex correctives and therefore part of a bear market, and I've marked them as W X Y X Z. Now, definitely the retracements in each X wave have been significant, and that puts you back on your thought process as to whether it's right or wrong. But the internal structure of what the market did in both these time frames continues to tell me that the view is right. The structure may be very different because when you look at the broad market or you look at number of stocks and sectors that have failed to perform during this time frame, it's a very good reminder of what I've already experienced during this period, that is in the 90s. If you were around then, and if you actually owned stocks, the Sensex that this has moved from the lower end of around 2800 to the upper end over 4000 to maybe 4500 almost every year, and this was a cyclical annual phenomena. And if you held on to stocks every time it reached above the 4000 mark, you'd probably be hoping that the stocks you own move up more. But they always fell more during the downtrends and rose less during the uptrends, and net over a 4 or 5 year period you would actually be losing ground unless you were in very particular sectors, because the auto sector topped in 1996, and after that it was mostly FMCG, pharma, the defensive sectors like today that did well. And somewhere in 99, you got a tech boom that caused a bubble rally. And every time I've talked about the possibility of a bubble building in India, it's essentially to look out for, is there any particular reason why that can happen? It could be because of a particular sector, or it could be because of monetary stimulus, and unless one of those reasons come in, bull market, which I would define as a minimum doubling of the index, which is what we saw in say 93 94 here, or in 2000 where the index went from 2800 to 6000, or in any other such time frame, even 2009 to 10, you could call a milli bull run where the indices doubled. But unless you can see that happen, no, you're not really sure you're into a bull market. And this is a late bear market bull run that we are talking about. So something like within a bear market you got a run because of tech sector, which was an external factor altogether. So we are not seeing any signs of that, and most of the sectoral behavior is the same. If you're owning a portfolio if you're not in the right stocks, if you're not in autos earlier and now in FMCG, pharma, you're probably not doing well. And if you look at just most mutual funds, they actually down over this period every time the index comes back to 6000. Similarly, as I showed, mid cap and small cap indices that are lagging. So I will actually look at some of those charts. But all of them keep telling me that at the large end, we are still doing an X wave. The reason I had to change medium term to up was essentially because this high is surpassed, which means the final leg of that uptrend, at least in Nifty, was not complete, and that reading is wrong. Changing it to up is essentially an acceptance that it is wrong, and then again you're looking for a top in the X wave, and trying to weigh as to whether that top would be very close to where we are, or whether it would be after another 5-10% move. And that's the answer I'm looking for. Today's market behavior itself is telling me that we don't have the answer to that, but the chances of it being closer to where we are exists, unless the high that we made yesterday at around 62.30 is actually surpassed. So I will look at the shorter term structure there to get into what's going on at the short end. But the long end, there's no change in the Condotype cycle theory that we are still showing experiencing winter behavior. That broader market continues to be failed, and every time I have seen a bull market, even if it's a simple index double situation, then You always have broad market participation. In fact, definition of a bull market should be that the junkiest of stocks that have no earnings also do extremely well during such a period, which is what we saw even in the Y2K run up within a cyclical bear market. So small stocks and mid cap stocks do exceedingly well during that period, which is something that we are definitely not seeing up until now. And so the next question, if the Nifty's crossed 6,112, the January high, wouldn't the other sectors also just catch up? Yes, they can. And when they do show signs that they are doing that, then it would be worth considering the fact that we are actually getting a more bullish scenario. But till we get evidence of that, so let's get on to, is there evidence? So here's the mid cap index. I showed this chart a couple of weeks back when it was coming very close to the fourth wave high and the 50% retracement. This is the NSE mid cap 50, and you can see on this chart it's not really gone very far. In fact, it's still showing fatigue. The short term daily momentum indicators are on sell. This is a daily bar chart, and today's bar chart is updated till intraday. The 20 DMA is around 2126, so close below that would not be a good sign. And we're still within 50% retracement. The entire rise is still within a channel which I've marked as A, B and C. Probably the C wave is extended to a slightly higher high than where we were last week, but just looking at this index, I can't see strength so far to think that we're in a bull run that's going to run away. Because if you see each of the strong rallies, even the one that we had last year in Jan, you had a pretty good run in these indices. Even if you go back to 2009, the major bottom, you had a pretty strong comeback after that bottom. So we're not seeing that right now. If we were into a genuine runaway, then we should have seen strength in all of these indices. In fact, the weakest segment within the broad market is actually the small cap index, which is retraced not even 23%, as you can see in this chart. It's far from achieving the targets of the channel, and it's just moving up around the lower crest of this channel. So anytime it breaks, and there are some signs that today it might actually close below that, so you need to wait till the end of the day. But if I draw a simple trend line from this low, and or maybe even go with the internal trend line of the last leg, which is somewhere, let me give you a number, around 6153. A close below that would be a sign that this index is giving up, and not having retraced more than 23% when the Nifty's crossed 6112 is again not really a sign of strength. It's a huge divergence. Of course, such divergences have existed even during a bull market, and eventually the broader indices catch up. But like I said, I must see signs of that happening, which is still not there. These indices are just losing momentum, and their short-term indicators are still on the sell side. So the overshoot that we've seen in the Nifty is something unusual because I don't think in all these years of market watching, that's 20 years, I've seen such a big deviation between at least the mid cap and a large cap index. Typically, if you're making a new high, you have some strength in the broad market, but that's definitely missing. The AD summation line, which I plot, is completely flat for this entire rally, which is again very, very unusual. So the markings I already discussed in the long short report, that the entire structure would be from December of last year is W, X, Y, X and Z. I have not changed it on this chart, but essentially what we are looking at is marking this as W, this low, this three wave sell off as X, this ABC as Y, possibly an X down here, and we are right now looking at Z. Now for those who are completely new to Elliott, which is many of you, when we are considering a bull market, my markings would have been 1 and 2. In fact, if I at any point of time think that I'm wrong and this is a bull market, the only marking would be 1 up here and 2, and then starting to look for a third wave. And we still don't see any signs of the behavior that a third wave should bring, which is a lot of strength in the whole market, not just a single index or a couple of stocks. So the markings remain W, X, Y, X, Z, and as long as you see A, B, C's and W's and X's, For those who are new, it means that you're in a bear market. We're just trying to measure each leg of the bear market and trying to figure out where the next leg will go. In the Monday update, what I was trying to explain is, are we doing A, B, and C already started, which is it's going to go vertically up till a new high 6,500, or uh, the second option where we complete A and then we do a deeper correction down to maybe around 59, 5,800, retracing 50 to 60% of A, which is what normally should happen, and then we do a C wave to maybe a slightly new high. This is the second option. But the most preferred option, looking at today's market behavior and the mid cap index, which I just showed, which is already losing momentum, is that most probably we ended Z here. The markings remaining exactly what I've been showing for several weeks, which is I thought that the sell-off in Jan to probably early March was 5 waves, but it would be an X wave, and the entire rise up then would be an expanded flat, where this low would be wave B. Okay, so as long as we are holding 60 to 30, the chances are we just completed Z at today's high. Now there are some early signs of that in the intraday chart of Nifty, and the intraday chart shows a potential 5-wave decline developing over here. So which is why I said today's high is going to be important. Okay, we have this development. What it can give you is, because you have a small 5-wave, is you can get a good retracement of that, either back to the 20 DMA around 6180 or up to 61%, which is around 6190, or in some cases you do end up to 78%, as high as 6200, 6210, before another leg down starts. Okay, and if this were a corrective leg, you would end up marking this as A, B, and C, and then look for a bottom, in which case the second scenario where we get a B wave low would be true. Else, if we start a larger sell-off, it would result in being marked as 1, 2, and 3. In the initial stages, we will not know what it is, but any move in any direction which is impulsive must result at least in 3 waves, 1, 2, 3, or ABC. And so I think there is still further downside after a minor pullback in the Nifty, which can take us back to closer to the 20 DMA, which is what I explained in yesterday's update, that if we break 6130, 6120, today's low, then we can head towards around 6070, which would be closer to the 20 DMA, which is 6070 is a 61% retracement of the last leg. So the 20 DMA is actually 6025 here on this chart. So we would look at that, and the structure up to the 20 DMA should give us enough indication as to whether a deeper sell-off is happening, and we continue to take it from there. So what is visible is that we do have some kind of a top at 6230, from where we start looking for a downward leg. Whether it's the end of Z or the end of A is something we'll answer along the way, but I would prefer to think that we are still ending Z, because we don't have participation from the broad market and a lot of the other indicators which I discussed in the long short report, whether it's the momentum swing, whether it's fifth wave in a couple of markets. All of those continue to remain true and continue to remain near-term risks that we need to watch out for. However, a final take, what if all this is wrong and we are headed higher? A move above 6230 is what would tell us that we are getting a larger C wave on the upside, which can continue to new highs. But unless we get that move, I think the first thing to look for is the potential for a wave A or a wave B on the way down. That's all in this update. This has been a slightly longer update so that I can give you insights into what these markings mean for the long term and for the short term, and I hope that's given you a lot of insight. Thank you.